Hello, and today I'm taking a look at the oil equipment and services sector. I'm going to do a stock filter for that. Please remember before I start that I do these videos just for fun as a hobby and always speak to a qualified financial advisor before making any investment decision. So the first thing I like about the oil equipment sector is that it's a totally bombed out sector that's been hated for many years. And to validate that, we look at the oil equipment sector chart, which we can see is in a dismal state. In fact, so bad that from 2021, the analysts stopped updating it because I think it had just become such a fragmented sector with hardly any players. It actually stopped being tracked by the UK analysts. It certainly ticks the first box of my thesis of it being a bombed out sector, making it attractive to me. The second thing is that rig counts have stabilized following a protracted downturn. So we had a massive downturn in investment. Everyone thought that oil and gas was going out of fashion. We were all turning to renewables and stuff. So the rig count dropped a lot, explaining this, what happened to the sector. But it's actually, in the recent years, it's actually been recovering. And so I think this creates an opportunity to invest in companies that have been out of fashion and under invested in, but whose assets might actually be becoming more valuable when you look at the trend in rig count. And this is one sector where there is a one particular factor, which is rig count, which gives you a great indicator of how the stock should be doing in that sector. And you can see that here where I've overlaid the rig count against the share price of Hunting, and there is an approximate correlation there. And so finally, the main reason why I'm interested in this sector is because with Trump coming in, he has a drill baby drill policy. And I think this will be good for this sector. It won't be good for the oil majors because I think that drill baby drill will actually bring down the price of oil, but it will be good for the oil services sector because these are the guys that facilitate that drilling. And it makes perfect sense to rely on this as a strong tailwind for this sector because it's definitely in the US's interest to increase their oil production. They're already the world's leading oil producer. I think that the US is going to be booming in the next 10 years, and a lot of that strategy is they need cheap oil to help fund all of the activities that are going to be going on in the US. And at the same time, having the low oil price through increasing their hydrocarbon production will also hurt their enemies, which are mainly Iran and Russia. So what I did is I started off with the oil equipment and services data I have. It was very easy to eliminate these three because they have market caps of less than 10 million, and a cursory look at their main fundamentals show them to be probable disaster zones. And so then that left me with these six stocks. And off the bat, Hunting looks very attractive. They're the only one paying a decent dividend, and their net income history and balance sheet looks healthy at first sight. And they've got a very low price to earnings and price to book ratios. So these look very attractive right off the bat. Looking at the net income histories, and John Wood Group, Petrofac, and Myself's Tech all have absolutely horrendous net income histories. A quick look at them to confirm that they were disaster zones, and it's very easy to eliminate these from my stock filter. So that leaves me with just Hunting, Ashtead, and Gulf Marine Services. Moving on to the balance sheets, actually, the balance sheets of Hunting and Ashtead look fairly good. In this, the blue bar is the market cap. The outer green and red bars are the long-term assets and liabilities, and then the inner green and red bars are the short-term assets and liabilities. So you can see things look very healthy here for Hunting and Ashtead. But Gulf Marine Services, it looks a bit weird. Now, Gulf Marine Services are actually a fairly simple company, which is something I like actually. They simply operate a small fleet of these offshore support platforms, which are very modern and have the ability to raise on these stilts when they get to the site. So they're a very interesting company, and I really like it how their business, because it's just based on ownership of these vessels, it's great to look into and kind of understand 360 what's going on in the company. However, focusing in on what's going on with their balance sheet, if we look at the long-term assets and the long-term liabilities, we see their long-term assets are actually the vessels that they own, simple as that, which are worth about 0.6 billion. Whereas on the non-current liabilities side, there's barely anything there. However, then looking at the short-term assets and liabilities, on the current assets side, they have about 50 million, which is mostly trade receivables for the ships they're renting out. And so that's a kind of a tidy 50 million. But then on the short-term liabilities side, we see that they've got kind of general running costs of about 50 million, which is kind of like in the short term, which is kind of like a match for what's coming in. But then on top of that, they've got like 250 million in long-term debt, which is obviously the debt they took on when they got those boats built in the first place. So they're only making 7 million a year in net profit, but they've got this mountain of 245 million of debt. So that obviously is like a very onerous situation to be in. Now, obviously, I'm sure they'll easily be able to restructure that debt and shift it to the long term again. But all the same, that's a very precarious situation. So it's quite easy to eliminate Gulf Marine Services from my shortlist. So that leaves just Hunting and Ashtead. So Hunting provide precision engineering goods and also some services. 45% of their business is actually oil and gas pipes and connections. This acronym here stands for Oil Country Tubular Goods. So they basically make the pipes and the valves and things for the oil rigs. So this tells us that they are a very good direct exposure. Why I'm interested in this sector, which is a healthy recovery in the rig count. Then 24% of their revenues are from perforating systems. So these are explosive charges which are used for when you're doing wells. And then 13% is subsea systems, which again is relevant. And they have 11% advanced manufacturing. So this is precision engineering for all kinds of things, including like fighter jets and stuff. So it's non-energy. So this kind of does provide some spice, which is always nice to have a little bit of spice, but not too much to detract us from the main reason that we're investing in this company, for which they're a direct hit. It's very encouraging that the majority of their revenues are all based in the US, this Hunting Titan segment being mostly in the US. There's obviously a very nice trend here in their net income. And then focusing on their balance sheet, obviously their long-term assets tower over their long-term debt. And we see their long-term assets are mostly property, plant and equipment and goodwill. So I think that's obviously their manufacturing facilities for making this stuff they sell, as well as some stuff that they rent out. And also goodwill will be kind of contracts they've got already set up. So it's a fairly healthy 0.6 billion of long-term assets, and they have hardly any long-term liabilities, and most of what they have is actually just leasing stuff and barely any debt, only 4 million. So it's clearly a very healthy comparison there, and it's great that they've got barely any debt, which is something I always like. And then when we look at the short-term assets and debt, which is obviously visually very appealing here, Their current assets are mostly inventory, so that's their valves and pipes that they've got manufactured, ready to ship out, and trade receivables, so goods that they've sold, they're just waiting for the payment, and 70 million of cash. So that's a very healthy 667 million of current assets. And against that, their short-term liabilities, it's mostly just the cost of goods related stuff, trade payables, and it seems 81 million of short-term debt that they use just for the general running of their business. So a very healthy mismatch of much more current assets to current liabilities. Now, this would be indicative of a very healthy cash flow. But actually, when I looked at their statement of cash flows, it's only actually a positive cash flow of 25 million, which seems kind of low versus this massive difference between the short-term assets and liabilities. But perhaps that's reflective of them being a manufacturing company. Perhaps that's why they've got a relatively small cash flow to their assets. But still, at least it's a good cash flow. But I'd say this is something I need to look into more deeply before, if I was to invest in them. But otherwise, generally, they look, everything checks out very good for this first cursory look, and they are definitely a direct hit on my Trump drill baby drill hypothesis for why you'd want to invest in this sector. Now, ASHT Technology Holdings, they only listed in late 2021. They rent out equipment for subsea oil, gas, and renewable projects. Actually, 31% of their revenues are from renewables. Now, they make generally robotics and survey equipment and also subsea engineering equipment. And a lot of their business comes from asset monitoring contracts where people hire them to come in on the long period and monitor that all their infrastructure is okay at these oil rigs. They have a good net income history, but actually it seems to be the growth in it seems to have slowed down a bit in the last couple of years. Most of their income comes just from renting out equipment that they own. And it's notable that 2/3 of their revenue is actually Europe. This actually I find a bit unfavorable. I don't really like the idea of investing in Europe because they've got backwards hydrocarbon policies. So taking a look at their balance sheet. So ASHT Technology Holdings kind of look okay, but because of their exposure to Europe, I'd say that I'm kind of fairly lukewarm to them. So I really like Hunting, and they're worthy of further investigation. And I'm only lukewarm about ASHT Technology. So I'm hoping that the oil price will actually capitulate next year. And so I'm thinking that actually Hunting will probably be thrown out with the bathwater and will get punished just because it's somehow related to oil. But actually, it will be a very good thing to invest in if the oil price is low because of drill baby drill in America. And so I think there could be a good opportunity to invest in Hunting, and I'll definitely be taking a more detailed look at them certainly by early next year. So I hope you enjoyed this stock filter for the oil equipment and services sector. Good luck with your investing and speak to you soon. I do videos like this one just for fun as a hobby. It's for entertainment purposes only. Always consult a qualified financial advisor before making any investment decision.